Good morning, everyone, and welcome to the Interest Group's webinar, 3 Tax Advantage Plans for Small Business Owners. This seminar is designed to give you an overview of the 3 basic small business plans that Congress has created for small businesses to be able to avail of retirement plan benefits for not only their employees but for the owners as well, or vice versa. In other words, there are some businesses that do not have any employees, so therefore these plans are just designed for the small business owner. My name is John Paul Ruiz, Director of Professional Development here at the Interest Group, and we welcome you to today's webinar. But before we get started, we just want to put a disclaimer in here that this webinar is purely educational, that as part of the ongoing commitment of the Interest Group to not only be a record keeper, one of the premier record keepers of self-directed retirement accounts, we also want to educate on the basic principles of retirement plans. In this particular webinar, we're talking about small business plans for small businesses. The Interest Group does not provide any investments or any investment advice or endorse any products at all. You heard that right. The Interest Group is purely a record keeper. We do not offer any investments or endorse any investments or give investment advice. The Interest Group is a record keeper of retirement plans that allows for individuals to invest in a broader array of investments. In other words, investments that some financial institutions would typically not offer. We would allow for you to be able to choose your own investment as a retirement plan account holder, as long as it's allowable under law, of course, and be record kept at the Interest Group. All information materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investments. In other words, seek professional help before you enter into any transaction to make sure that you dot your I's, cross your T's, and have done proper due diligence before entering into any transaction. Now, the agenda for today's course, before we get started, we'll talk a little bit about the Interest Group and who's sponsoring this particular webinar. Then we will dive into the 3 small business plans that are designed for small business owners. We'll talk about the common misconceptions about retirement planning, or in other words, the common things that people say that are not true in regards to retirement plans that sometimes prohibit them from entering into retirement savings. But keep in mind, Congress created a lot of these tax advantage plans to encourage people to save up for retirement. Next, we're going to talk about what is the benefit of self-direction. What is self-direction? As mentioned earlier, the Interest Group is a record keeper. We also provide custody services for the assets that are held under a retirement plan being record kept at the Interest Group. In other words, we basically administer the account, but we don't offer any investments. You, the investor, gets to choose what type of investment you would put under your retirement plan. Thus the term self-direction. We'll also take a look at some timely tips, given the fact that we're talking about small business plans. We're talking about small business owners. And depending upon the structure that they've created for their business, those have certain tax return due dates. We'll talk about the timely tips on when these tax return due dates are in order for the small business owner to know when to establish a plan, as well as, number 2, when do contributions have to be made. Last but not least, way to encourage and educate employees. If there is an employer that has employees, which some of these small business plans allow for employees to be covered as well, how do you encourage your employees to participate in the plan? We'll take a look at that. And last but not least, we'll open up the phone lines for any questions, and hopefully we'll have answers for the questions you have. Again, the seminar will last approximately an hour long, devoted primarily initially to the presentation of the material, and then we will open up the phone lines to answer any questions that you may have in regards to the materials presented. So if you have any questions throughout the seminar, please jot your questions down, and we will open up the phone lines later on to answer those questions. Now, a little bit about the Interest Group. We've been around for 35 years, focusing mainly on administering alternative investments. In other words, we don't offer stocks, bonds, or mutual funds, but we do offer the record-keeping platform that allows for individuals to choose their own investments. That's the term self-directed retirement plans. We've been a leader in the industry not only from a record-keeping perspective, but also from an education perspective, which this is an arm or a part of our efforts to educate the industry. We, as a record keeper, we process around 12,000 to 16,000 client transactions every month, and we administer over $3 billion of investor assets. Not only are we a provider of record keeping, we also provide education. Our knowledgeable staff, for the most part, a large percentage of them carry what we call the Certified IRA Services Professional designation through the Institute of Certified Bankers, in other words, the ICB, which is an arm of the American Banking Association. We do offer these webinars as a part of our CE program, so for those individuals who are looking for continuing education, contact the designation or financial institution that provided your designation to see if they would honor the attendance of this particular webinar as part of your CE endeavors. In other words, your continuing education credits that the designation requires. We do offer some of these presentations if there's a large enough group on a national level. Will it be local, in person, or similar to situations like this, we can also offer the presentation through what we call webinars. And lastly, we do own a school, which I myself wrote on behalf of the Certified IRA Services Professional designation as a preparatory course for individuals wishing to sit for the examination for such webinar, and that's what we call the IRA Academy. We are having an IRA Academy for retirement professionals in October of this year in Orlando, Florida. It'll be held from the 23rd, and the exam will be administered on the 27th. Again, our CE or our presentations are honored by quite a few designations, such as the CFP Board, Certified Financial Planner Board. We are an approved continuing education provider by the IRS for the enrolled agents, not actuary, but enrolled agents, NASBA, as well as other designations. Now let's dive into the material. This is the exciting part. We are going to talk about 3 tax advantage employer-sponsored plans for small business owners. Now keep in mind, I said a mouthful of words, but if you pick it out, these are employer-sponsored plans. So in other words, if you're an employer, whether it be self-employed, a partnership, whether it be a corporation, and you're a small business owners, this is the right course for you because it's going to talk about the 3 basic small business plans designed for small business owners. Now, another resource where you can find this information, which is really good reading, is Publication 560 by the IRS, which talks about the 3 different plans that we're talking about here. Called the SEP, Simplified Employee Pension Plan, has been around since 1978. The Simple IRA Plan, the Savings Incentive Match Plan for employees, which the first plan you could establish was in 1997, since it was created by the Small Business Job Protection Act of 1996. And last but not least, the Individual 401k Plan, which is a regular 401k plan, but it's designed for small business owners that do not have any employees. Unlike regular 401k plans that have employees, those plans are subject to what we call non-discrimination tests. In other words, the plan must be designed so that it doesn't favor the people who make a lot more money than the rank and file. But given the fact that there are businesses out there that do not have any rank and file employees, in other words, they only employ the employer or multiple employers. In other words, in a partnership perspective, all our owners, no rank and file employee, therefore, that plan is not subject to what we call non-discrimination testing. Thus, we get what we call the Individual 401k Plan. We'll talk about each of these plans in greater detail as we go through this course. Again, the SEP IRA, let's begin with that. It's called a Simplified Employee Pension Plan. This has been around since 1978. A best way to describe this plan is what we call a profit sharing plan. So in other words, if you have a small business owner and they're going to make a profit sharing contribution because they did well that year, well, they can share the profit. That's where we get what we call the profit sharing component of what we call a SEP IRA. The SEP plan has two components to it. One is the document that establishes the plan, who can participate in the plan. In other words, how old must you be in order for you to participate in the plan, and how long must you have worked for the employer in order for you to participate in the plan. Now, keep in mind, these particular rules under the plan is also applicable to the employer. So if the employer says that you must have worked for me for 2 years, well, then the employer is also subject to that 2-year rule. However, for all intents and purposes, this plan is designed to share profit. Now, we're going to take a look at what the maximum contribution amounts are for SEP plans in a second. Now, once the employer decides on how much they're going to contribute or share for that particular year, it has to hit a tax-deferred account. That tax-deferred account chosen by Congress is what we call the traditional IRA. The traditional IRA is an IRA for individuals. That's where the term I, or that's where the I comes from in an IRA. It's an individual retirement arrangement. The employer gets the tax deduction. The contribution goes to the employee's traditional IRA, also known as a SEP IRA for the most part for a lot of financial institutions, because the contribution is reported differently than the annual contributions that could have been made by the individual in their traditional IRA. So for all intents and purposes, SEP IRAs are the same as traditional IRAs. The contributions made to the SEP IRA receive the traditional IRA benefits, such as the earnings grow tax deferred. In other words, the earnings are not going to get taxed until when? They take it out. No, so what's the moral of the story here? Don't take it out. Have it continue to accumulate on a tax-deferred basis, given the fact that the earnings are not going to get taxed. It's going to continue to grow, not being taxed, until the point wherein the IRA holder or the participant decides to take the money out. Since this is a profit-sharing plan, a magical $2 million question a lot of people ask is, do I have to make a contribution every year? The answer in this particular plan is no. Contributions to a SEP plan are what we call discretionary contributions. In other words, discretionary means at your discretion, you can share profit or not, meaning if you don't have any profit for the year, you don't have to make a contribution. The maximum contributions, again, will be talked about in the following slide. In a recap, you have to be a business in order for you to open up a SEP plan. Number two, there can be eligibility requirements that the employer could put in the plan document on who can participate, but the employer is subject to those rules as well. The contributions hit each individual participant's SEP IRA, also known as a traditional IRA. The employer, of course, gets the tax deduction for the contribution, but the employee receives the contribution in their SEP IRA or traditional IRA account. And lastly, contributions to a SEP IRA are discretionary. In other words, you don't have to make a contribution on a yearly basis. The maximum contribution for a SEP IRA for 2016, and the reason for that is that SEP IRAs can be established up until the tax return due date plus extensions of an employer. And we'll talk about the tax return due dates for each type or each type of structure the employer may be, whether it be sole proprietor, partnership, or corporation. We'll take a look at that later on under the Timely Tips slide later on in this particular course. But the contribution for 2016 is the smaller of 25% of each individual's compensation, not to exceed $53,000. As an example, if somebody has $100,000 worth of income, then the maximum contribution that they could potentially receive is up to the lesser of 25% of that amount, $100,000, or $53,000. In other words, in this particular example, it would be $25,000. However, there are some employers that owners of company that make more than that. Let's say they make $300,000. Then we have to compare the lesser of the two, lesser of 25% or $53,000 in my example for 2016. And of course, it'll be capped at $53,000. Now, for individuals to receive a contribution for the year after they've been eligible, meaning that they've satisfied an age or a service requirement that an employer may impose, could also be prohibited from receiving a contribution. In a SEP plan, there is a maximum or a minimum compensation limit that an individual must receive in order for them to receive a contribution. Now, why did Congress create this particular rule? The reason for that is small business owners hire some employees on a seasonal basis. In other words, if they only work for them for 2-3 hours or a week or 2 weeks for the year, an employer could actually exclude those individuals from receiving a contribution even though they have worked for an employer for, let's say, the minimum eligibility service requirement, or they're age 21 already, as an example. Even if they're eligible to receive a contribution in the plan, they could possibly be excluded from receiving a contribution by virtue of this particular provision. It's called the current year compensation amount that they should have received, and the amount is $600. In other words, if an employer says you must earn at least $600 in order for you to receive a contribution for the year, employees who are eligible by virtue of the service and age requirement may still not receive a contribution because they didn't hit that $600 mark. But the maximum contribution, again, is the lesser of 25% or $53,000 for 2016 and $54,000 for 2017. So the higher the income of the employee, the higher the contribution that they will receive. Now keep in mind, you may have been reading between the lines already, all eligible employees, once the employer decides on whatever percentage that is, must receive the same level of contribution. If they don't, then each individual employee who received a contribution must be lowered down. In other words, the amounts may have to be taken out of their account to lower it down to the lowest amount received by any employee in that particular year. So in other words, if everybody received 25% and one received 10%, well, everybody's contribution amount must be lowered down to that 10% mark. That's the rules. In other words, to be fair, Congress put in place that whatever percentage is received by any employee, the highest amount, or whatever, the lowest amount, everybody else must be lowered down to that lowest amount. Maximum amount, as a recap, lesser of 25% of compensation, not to exceed a certain dollar figure for the year. In 2016, it's $53,000. For 2017, it's $54,000. Now, what are the tax advantages of a SEP plan or SEP IRA? Contributions, again, are tax deductible to the employer. Contributions are made to traditional IRAs, also known as SEP IRAs, established by employees. Now, keep in mind, if an employee does not want to establish a traditional or SEP IRA to receive a contribution, the employer can establish one on their behalf. Why is that? Because remember, the lowest amount of contribution received by any employee will determine the maximum amount everybody else will receive. If somebody doesn't want to open up a SEP IRA and they didn't receive a contribution, well, guess what? Everybody else's contribution must be lowered down. If it's zero, well, then that's not good. That's why Congress said if an employee does not want to establish a traditional IRA/SEP IRA, the employer can establish one on their behalf. Here's another benefit which I haven't found to be beneficial to a lot of employers. Under the current legislation, employers may be eligible for what we call an employer startup, a retirement plan startup credit. Couldn't find the words there for a little bit, but what that means is that if there's any cost to an employer for setting up a retirement plan, and they haven't had a retirement plan 3 years prior to the establishment of a new one, they can take up to 50% of the first $1,000 of cost to start up that plan and use it as a tax credit on the employer's taxes. Now, think about it. In a SEP plan, for those of you who have ever established it, but if it's brand new for you, this is good to know. Documents for a SEP plan are typically provided for free by any provider. You go to any financial institution you want to establish a SEP plan, they'll provide a document to you for free because they got it for free from the IRS. So there's no cost to that. Setting up a traditional IRA is really taken on the brunt end of the expenses are taken on the brunt end by the participants because they have to pay the fees for the traditional IRA. So again, there's no employer fees for that. So where do the fees come from? That would be something that you would need to discuss with your tax advisor to see if there's any additional cost that you may have incurred if you're establishing a SEP plan to be eligible for that tax credit. Now, keep in mind, this tax credit is also available for a simple, which we'll talk about later on, as well as individual 401k plans. Now, since contributions are going to each individual traditional IRA, the earnings, again, grow tax deferred. In other words, it's not going to get taxed until the individual distributes. Capital gains on sale of investments under an IRA are not taxed. So if somebody owns a mutual fund and they buy a mutual fund, they sell the mutual fund, the increase of that mutual fund is not taxable. Why is that? Because it's tax deferred. If you buy a piece of property like a piece of real estate in a self-directed account and it's bought outright from assets or cash that's in the IRA, and then you sell it, the capital gains are also deferred from taxation, but will be taxable upon distribution. Employees can also take their SEP IRAs with them anywhere. Why is that? Because the contributions go into a traditional IRA. A traditional IRA can be transferred to any traditional IRA provider. It could be a broker-dealer, it could be a bank, it could be a self-directed provider like the Entrust Group. Since contributions, again, go to IRAs, those can be moved at any financial institution. Now let's take a look at the simple IRA. Excuse me. A simple IRA is a plan, an IRA-based plan. What does that mean? Although you have to have a document, in other words, the employer has to sign that document to establish a plan, who's eligible to participate, what contributions are being made, so on and so forth. This particular plan contributes the contribution into each individual account. However, in this particular IRA, individual retirement arrangement, it has special rules. Since it's a simple IRA, a simple plan, then the IRA is called a simple IRA. One of the main difference between a traditional IRA and a simple IRA is this main rule. Assets in a simple IRA cannot be transferred to any other retirement plan prior to 2 years. The clock for the 2 years start from the initial contribution made to a simple IRA. Within that 2-year period, distributions from a simple IRA will not only be taxable, it'll also be subject to a higher penalty, where in traditional IRAs are typically subject to an early distribution penalty of 10% if you're under the age of 59 and a half. Simple IRAs are subject to a 25% penalty if you take a distribution prior to the age of 59 and a half. That's why it has its own document called a simple IRA. In other words, it has its own rules. But simple IRAs, for all intents and purposes, is available for employers with less than 100 or 100 or fewer employees that have received $5,000 in compensation. In other words, if you have more than 100 employees, you got to take a look at what their compensation is to determine whether or not you're eligible to have a simple plan. But if you have fewer than 100 employees, then you should be able to establish a simple IRA program at your business. Again, you have to be a business to establish this particular plan. Employee contributions, in other words, let's stop there for a second. Unlike a SEP plan where it's all employer contributions, in a simple plan there are actually 2 contributions to be made. One, the employee can actually choose to contribute to the plan by having an amount taken out of the paycheck and contributed to the plan called a deferral. This is done through payroll deductions. A little bit different than a SEP plan. SEP plan is a profit-sharing contribution, whereas a simple plan, an employee can take money out of their paycheck and put it in the plan. Now, a lot of employers like this. Why is that? Because that money is not coming from the employer's pocket. It's coming from the employee's pocket. However, Uncle Sam says if you're going to have this simple IRA plan, whatever the employee puts in, the employer must match. The maximum match is up to 3% of a person's income. Let me give you an example. If an individual makes $100,000 again, and they defer, let's say, $5,000 of their paycheck into the plan, the employer must match dollar for dollar up to 3% of that individual's income. At $100,000, the maximum amount is 3. Therefore, the individual will receive a $3,000 match to their $5,000 deferral. Why is it only $3,000? Because it's capped at 3%. Right? Matching contributions are only made on behalf of deferring employees. In other words, even though you have a lot of employees in your company, it's still an attractive plan for a lot of employers. Why is that? Because only the individuals who defer money out of their account are the ones that are matched. In other words, if a participant, although they're eligible, does not choose to defer into the plan, they won't receive a match. Now, keep in mind, matching contribution is only one of the two options that the employer can choose to contribute to the plan. Another one would be what we call a non-elective contribution. An employer could choose to make a 2% profit-sharing contribution on behalf of all employees. So in other words, even though there's mandatory employer contributions, they can either choose a match, which is what a lot of employers choose, or a 2% non-elective or 2% profit-sharing contribution. The maximum contribution for employees in 2016 and 2017 is $12,500. Now, unlike a SEP plan, employers can no longer establish a simple plan for 2016. Remember, SEP plans can be established up until the tax return due date plus extensions of an employer, but simple plans have a different deadline. Simple plans always operate on a calendar year, in other words, January 1st to December 31st. And employers must have established a simple plan by October 1st of that calendar year. So if an employer has not established a simple plan for 2016, it's too late. However, they are still eligible to establish a plan for 2017. However, if an employer had a simple plan for 2016, the maximum deferral limit is $12,500, but the employer must match that dollar for dollar up to 3% of compensation. Now, since this is a deferral, in other words, money coming out of a person's pocket, if a person is at least age 50 before the end of the taxable year, they can put an additional $3,000 in. In other words, it's a privilege for people who have at least attained age 50 to make an additional deferral into the plan. That is what we call a catch-up contribution. So in other words, the maximum contribution is truly $15,500 for an individual who attained at least age 50. In other words, if they're 54, they're already eligible for catch-up contribution. They must at least be age 50. Now, what are the tax advantages of a simple plan? Employer contributions, again, are tax deductible for the employer. Investments grow tax deferred. In other words, whatever investment they choose, the earnings or the growth in that investment is not going to be taxed until when? They take a distribution. Employers may also be eligible, again, for a tax credit up to $500, which is 50% of the first $1,000 of expenses or costs in starting up the plan. Employee contributions are made on a pre-tax basis. In other words, it reduces the taxable income of that employee because they didn't receive it. It was placed in the plan. It defers the taxation in that portion. It reduces their taxable income for the year. Employees may also be eligible for a tax credit based on their adjusted gross income. We're not going to walk you through that in this particular seminar for the sake of time, but if you establish a simple plan and employees start deferring into the plan, you might want to have them check with their tax advisor to see if they're eligible for the employee savers tax credit. In other words, by saving, they may be eligible for a credit on their taxation if their income is low enough. Also, employees can take their simple IRAs with them if they move to another employer. In other words, they can move that simple IRA to another simple IRA at another financial institution if they wanted to. Or after 2 years, those simple IRAs can be moved to a traditional IRA. If you recall, we mentioned about the 2-year rule. Now let's take a look at the individual 401k plan. The individual 401k plan is also a small business plan designed specifically for this characteristic of an employer. An employer with no rank and file employees. They can have other participants in the plan, but they all must be owners, such as the spouse of the owner who is actually working for the business, or maybe a partner or other owners that are in that particular structure that the business is established. As long as they don't have any eligible rank and file employees, they are a candidate for the individual 401k plan. Now, let me answer this question already, which is a question asked by a lot of people. What if the business starts hiring employees? Well, if you have an individual 401k plan, that 401k plan just became a regular 401k plan. Now, if an employer would like to put other additional provisions in that plan, well, then it's no longer an individual 401k plan. subject to discrimination testing, then it would be highly recommended to talk to your tax or legal advisor and seek out an administrator for that 401k plan that is able to run those non-discrimination tests on behalf of the plan. But if there are no rank and file employees and the plan is not subject to that, well, then it's still an individual 401k plan, and we'll proceed. We're talking about what an individual 401k plan is. Similar to your simple IRA, an individual 401k plan also has two components of a contribution. One is that the employee can actually defer their paycheck into the plan. However, unlike a simple plan, individual 401k plans have a higher deferral limit. We'll take a look at what that limit is. If you recall, it's $12,500 for a simple. It's a lot higher than that in an individual 401k plan. In an individual 401k plan, the employer can also choose to make a contribution called a matching contribution, or a lot of individual 401k plan owners are choosing a profit-sharing contribution. If you recall, the maximum profit-sharing contribution is the lesser of 25% of income, or a dollar figure, not to exceed $53,000 for 2016 or $54,000 for 2017. In other words, in an individual 401k plan, it's a lot higher. Now, let me address the 2016 issue first for individual 401k plans. If employers did not establish an individual 401k plan by the end of their fiscal year in 2016, they're not eligible for an individual K plan for that year. In other words, the document to establish the plan must be signed by the end of the fiscal tax year of an employer. And typically, most individual 401k plans run on a calendar year. In other words, January 1st to December 31st. But it's not too late for 2017, and that's why it's in this particular seminar. Individual 401k documents have to be signed by the end of the fiscal tax year in order for them to be able to contribute to the plan. Again, there's two different types of contributions. One is the employee deferral, and number two, an employer contribution may either be a match or, more commonly, a profit-sharing contribution, which has a maximum of the lesser of 25% of compensation not to exceed $53,000 for 2016 and $54,000 for 2017. Here's another look at that. The employer contributions has a maximum of the lesser of 25% of compensation not to exceed $53,000 for 2016 and $54,000 for 2017. The employee elective deferrals are a lot higher than simple plans. The maximum amount is $18,000 for 2016 and $18,000 for 2017. So if you have entrepreneurs that are employers and they don't have any employees and they want to maximize their contribution, an individual 401k plan may be something that they might want to consider. Catch-up contributions are also higher in an individual 401k plan. Unlike $3,000 for simple plans, it's $6,000 for individual 401k plans. Another benefit of an individual 401k plan in comparison to a simple is that an employer could add what we call a Roth component in an individual 401k plan, where in simples, there's no such thing. Here are the individual 401k plan tax advantages. Employer contributions are tax deductible to the business. In other words, the profit-sharing contribution is tax deductible to the business. Earnings on the investments that the participants choose to invest in are tax deferred, similar to your simple or SEP IRA. But keep in mind again, simple IRA and SEP IRAs are IRA-based types of plans. Individual 401k plans are a little bit different. It's a pooled trust. In other words, everybody's account is in one big trust, but being tracked separately. Therefore, they cannot move their assets to another employer unless they have what we call a distributable event. Designated Roth deferrals may also be adopted in an individual 401k plan. So in other words, instead of deferring pre-tax into an account, it may be after tax, called Roth deferrals. And then those Roth earnings may be distributed eventually tax-free. Now let's take a look at the common misconceptions by small businesses in regards to small business accounts. Some people say, why should I establish an employer-sponsored plan? I already have an IRA. And the answer is because contributing to a retirement plan under an employer-sponsored plan has higher contribution limits, number one. And number two, around 18 to 42% of an individual's retirement income typically comes from an employer-sponsored plan. IRAs are only a part of what we call personal savings. Individuals, according to the Employee Benefits Research Institute, must set aside as much as they can on an employer-sponsored plan, especially if the employer is matching that contribution. Because remember, in a simple plan, as an example, employers are matching dollar for dollar. In other words, if you're the employer and employee, you're matching your own contribution dollar for dollar, 100%, to 3% of your compensation. Thus, therefore, you can bank away a lot more assets for retirement later on. Here are some of the common misconceptions. There aren't any plans to fit the size of my business. That is not true. Retirement plans have been created, multiple types have been created by Congress to fit any size of business. My investment options are limited and out of my control. That is also not true. Employers can choose a broader array of investments in which their contributions can be invested in. And as a matter of fact, self-direction is one of those ways to diversify a portfolio, because you're not limited to what the investment provider is offering you, but you, the investor, can actually choose what investment you want to invest in as long as it's allowable under law. Retirement savings plans are a hassle and are complicated, which is also not true. That's why the Interest Group has gone into for 35 years as a record keeper. We do the record keeping of your plan. However, there are certain responsibilities in alternative investments that are placed on the retirement plan account holder. Given the fact that the retirement account holder is the one that chose the investments, there are certain requirements in doing so. Let me give you an example. If somebody invests in a piece of real estate, like a rental property, well, of course, taxes have to be paid. There has to be a vetting process by a third party, and on who's going to be renting the property. So there's a little bit more steps to take, but the rewards are great if the investment chosen is and does give back rewards based on what the investor has chosen. In other words, there's an opportunity to possibly and potentially increase your retirement savings for the future. I have no control over the contribution amount, which, of course, after we've covered certain slides already, an employer has the option. SEP plan is discretionary. In other words, at your discretion, you can contribute or not contribute on a yearly basis. All retirement providers are the same. That is not true, because some retirement providers offer the investments that they offer, like broker-dealers, stocks, bonds, mutual funds. Your banks, you have CDs, money market accounts. There are also other providers that basically do not offer investments but allows the investor to choose the investment that they choose to invest their contributions to, whether it be real estate, precious metals, private placements. Those are just examples of other types of investments that are available to investors for their retirement plan assets. Now, benefits for self-direction for retirement plan savings. Small business owners can make their own decisions on retirement savings because they can choose their own investments, again, in a self-directed account. Investments are not limited to a list that the brokers provide. In other words, we're not limited to stocks, bonds, and mutual funds. You can actually choose any investment that you choose to invest in, as long as, number one, the investor is qualified to invest in the investment, and number two, it's allowable under law. There are only 3 different types of investments that are prohibited by the code, and one of them is under a revenue ruling. First 2 are collectibles and life insurance contracts. As long as it's not a collectible art, collectible, as long as it's not on the list of collectibles that the Treasury Department has created, and it's expanding, as long as it's not a collectible, you should be able to have that under an IRA. Number 2, life insurance contracts. In other words, Congress prohibited term life insurance under an IRA. The third one is, by virtue of its characteristic, an IRA cannot invest in an S-corp. A trust cannot be a shareholder of an S-corp. Therefore, an IRA is prohibited from investing in S-corps. But if it's not those 3, an IRA can invest in multiple or a broader array of different types of investments under self-direction. And there are tax advantages for businesses of all sizes because keep in mind the employer can use the contributions as a tax deduction. The employees could possibly get a tax credit if their income is low enough. There are benefits in saving for retirement. Now, here are dates that are very important. Why is that? If you're an employer trying to establish a plan and you're trying to make a contribution, you might want to know when your tax return due date is, because as mentioned earlier, the establishment and contribution deadline, as an example for a SEP plan, is up until the tax return due date plus extensions of an employer. So if an employer filed for an extension for 2016, not only can you establish a SEP plan, you can still contribute to that SEP plan as long as you are still within your tax return due date plus extensions. And here are those significant dates. Sole proprietors and C corporations typically have a tax return due date of April 18th. Corporations used to have a March 15th deadline, but C corporations moving forward have been given a deadline of April 15th. But if April 15th falls on a weekend or a holiday, you get the following business day, and that's why we have April 18th. If the sole proprietor or C corporation applies for an extension, they automatically get a 6-month extension, which puts it in October 15th. But since October 15th falls on a weekend or a holiday, it's the following business day. For partnerships and S corporations, the deadline is March 15th. However, if they filed for an extension, the deadline is automatically 6 months from that, which puts it at September 15th. So in other words, if an employer for 2016 does not have an employer plan and they've filed for an extension, they can still possibly have a SEP plan for 2016. And obviously, of course, they can have a SEP plan for 2017. For individual 401k plans and simple plans, there are only availabilities for 2017. Now, how do you encourage your employees to participate in the plan? Why would you want to encourage employees to participate in the plan like a simple plan? Why is that? Because you want to be able to retain employees in some cases. In other words, encouraging them to participate may allow for an employer to retain those employees. And here are some of those reasons why you would want to encourage how to encourage your employees in participating in the plan. You may want to do it as an automatic enrollment. In other words, if an employee does not say anything after you've given them the initial notice, a certain percentage may be taken their paycheck if that's what they choose to agree upon. Providing materials to your employees to inform them of the different types of investment in an account. As an example, talking to the investment advisor, providing prospectuses on the types of investments that are available. In a simple plan, providing a matching contribution. In other words, you won't receive the match unless you defer. Holding quarterly meetings as far as instructing the employees on the different types of investments available in the plan also allows for the employer as well as the investment provider to get in front of these employees to encourage them to save up for retirement. All right. Well, it's 12:07. Our hour, a little bit over an hour, is up. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. We thank you for attending today's seminar on the 3 small business retirement plans for small business owners. We hope you enjoyed this presentation and question and answer. I hope you find it informative. And please visit us at our website if you're considering self-direction. Of course, you're not limited to that. We thank you for attending today's seminar and looking forward to having you again in a future Entrust webinar. Goodbye now.